GameStop was a struggling video game retailer in early 2021, with a share price hovering around $20 and a market cap below $2 billion. What made it a target for investors was the massive amount of short interest. More than 100% of its float had been sold short, meaning more shares were borrowed and sold than actually existed. Short selling works like betting a stock will fall. A trader borrows shares, sells them at the current price, and hopes to buy them back cheaper later, returning the loan and pocketing the difference. If the price climbs instead, the short seller must buy back at a higher price, incurring a loss that can grow without limit. Hedge funds such as Melvin Capital and Citron Research built some of the largest short positions in GameStop. By mid-2020, Melvin alone had shorted roughly $12 billion worth of GameStop shares, a bet that the company would continue to lose market share to digital competitors. Meanwhile, a community of retail traders gathered on the subreddit r/Wall Street Bets. Starting in late 2020, members began posting about GameStop's high short interest, labeling it a short squeeze opportunity and encouraging collective buying to force shorts to cover. In early January 2021, the momentum shifted. Retail investors started buying GameStop shares and, crucially, call options, contracts that give the right to purchase shares at a set price. The surge in options forced market makers to hedge by buying actual shares, adding further buying pressure. From 13th January to 27th January, GameStop's price exploded from under $20 to an all-time high of $483, a rise of over 2,300%. Daily trading volume topped 500 million shares, far exceeding the total shares outstanding, highlighting the frenzy. As the price climbed, short sellers scrambled to close their positions. Buying back shares, known as covering, added more demand, creating a feedback loop. This is the classic short squeeze. The very act of covering pushes the price even higher, squeezing out more shorts. The squeeze inflicted massive losses on hedge funds. Melvin Capital reported a $4.4 billion hit, forcing it to seek a $2.75 billion capital injection from other funds. Citron Research, after initially profiting from a short, reversed its position and posted a loss of over $1 billion. During the peak, several trading platforms, most notably Robinhood, halted buying of GameStop and other volatile stocks. The sudden restriction sparked accusations of market manipulation, lawsuits, and a wave of congressional scrutiny over the power of broker-dealers. In February 2021, the U.S. House Judiciary Committee held hearings where CEOs of Robinhood, Citadel, and representatives of hedge funds testified. Lawmakers questioned whether the halts protected investors or shielded institutional interests, and they called for clearer rules on short selling and market access. After the frenzy, GameStop's price collapsed back to around $50, wiping out many late-entering retail investors while rewarding early participants. The episode sparked new SEC proposals on short sale disclosure, tighter control of payment for order flow arrangements, and a broader debate on the democratization of market participation. The GameStop saga shows how coordinated retail action can challenge entrenched Wall Street bets, but it also highlights the risks of extreme volatility and the importance of transparent market structures. It reminds us that markets are not just numbers, they are driven by people, platforms, and the rules that bind them.